Why do your EMIs increase, your prices go up, and even job markets slow down all at the same time? It's not random. It's all connected by one invisible force: interest rates. Let me ask you something. Have you ever noticed that sometimes everything feels expensive at once? Rent goes up, food prices rise, loans feel harder, jobs feel less stable, and you start thinking, what is happening to the economy? Most people assume these are separate problems, but they're not. They are all connected to one central control system in the economy. And here's the interesting part. Do you think interest rates only affect loans, or do they affect your daily life too? Because most people only see one side of it, they're borrowing, but there's much more happening behind the scenes. Connection 1, interest rates and borrowing cost. When interest rates go up, borrowing becomes expensive. Home loans, car loans, credit cards, business loans, everything costs more. Question for you, if your EMI suddenly increased by 20%, how would your monthly budget change? Because that's exactly what happens in high interest environments. Now here's the hidden link. When prices rise too fast, inflation, central banks increase interest rates. Why? To slow down spending. But here's the question. Have you ever felt like prices rise faster than your salary? That's inflation in action. And interest rates are used to control it. Connection 3, interest rates and jobs. This is where most people get surprised. When interest rates are high, companies borrow less, and when companies borrow less, they expand less. And when expansion slows, what do you think happens to hiring? Jobs slow down, growth slows down, hiring becomes careful. So yes, interest rates indirectly affect job opportunities. Connection 4, interest rates and spending power. When borrowing becomes expensive, people spend less. Big purchases get delayed, homes and car purchases as well. Even business expansion and investments. Question, have you ever postponed a big purchase because EMIs felt too high? That's interest rates influencing your decision. Connection 5, the full cycle. Now connect everything. High interest rates leads to less borrowing, which leads to less spending and slower business growth, which leads to fewer jobs and finally controlled inflation. It's one complete system, not separate events. Now you don't need to become an economist, just understand this simple rule. When interest rates go up, loans become expensive, jobs slow down, and spending reduces. When interest rates go down, loans become cheaper, spending increases, and jobs grow faster. Simple mindset shift: instead of reacting to prices, start understanding the system behind prices. And here's a powerful question. Before taking any loan, do you ever check whether interest rates are rising or falling? That one awareness can change financial decisions completely. So here's a real question for you. Which do you think affects your life more right now? Inflation, interest rates, or job market changes? Comment just one word. And be honest, do you think you understand how the economy affects your daily life? Or does it feel invisible? If this made things clear, subscribe to Wealth Insure Lab for simple financial breakdowns every week. See you in the next one.